Representing Police Commissioner Sewell.
Allison Hirsch, representing Controller Brad Lander.
John Dorsey, alternate for Controller Brad Lander.
Steve Meyer, I'm an invited participant.
Shu Ray, representing Mayor Eric Adams.
Kevin Liu, Finance Commissioner, Neighborlex.
Joe Alejandro, PBA.
Arthur Regner, PBA.
Norma Caddy, Wilshire, CLBR.
Rob Appling, Wilshire, here by invitation of the trustees.
Nicole Giambrisi, Police Pension Fund, present by invitation of the fund.
Anthony Burley, SBA. Jeffrey Ward, DEA.
Lou Turco, LBA. Johnny Ramirez, CEA.
Bob Senskisted, Pension Fund, present by invitation.
Kevin Holleran, Pension Fund, present by invitation.
Ed Furman, Direct Asset Management, here by invitation.
John Mercerberg, Controller's Office, present by invitation.
Michelle Davidson, Axia, here by invitation.
Leon Dublin, Control's Office, present by invitation.
Brett Manerick with Axia, present by invitation.
Norman Filargian with Axia, present by invitation.
Okay, John, anyone else?
So,
Yes,
I'll just ask
Sandra Vitals by invitation. I'm here for Axia.
great. And I just want to ask if anyone from the Actuary's Office is on?
Mark Skevich, Office of the Actuary by invitation.
And if the Law Department's on?
I don't think they're present.
Okay, we'll just note if they do participate in the meeting. I just want to
And,
know.
I'm sorry, John, to interrupt, Chris McGrath, PBA by invitation.
Great, thank you, Chris. So I just want to acknowledge that there are several members of the Bureau of Asset Management on who will identify themselves in the event that they address the board in executive session or public session for that matter. So with that, we have a very short, as far as items, we have a very short agenda in the public session. We're going to start with a strategic asset allocation, and I'll turn it over to Steve, see if he has any words that he'd like to give before Ed makes his presentation.
Yeah, terrific, John. Thank you. So we're making, obviously, very good progress on looking at the strategic asset allocation. We started this process back in January. We're working with Wilshire and all 5 of the general consultants across the New York City retirement systems. And we've got a presentation chock full of new information and insights, which I'm going to ask Ed Berman to run us through and open it up to any questions. Right here.
Oh, perfect, right here. So this is interactive, so if there are questions, please feel free to ask them. And anything you hear today that you want clarification on at a later point, Ed and his team are available. Steve's always available. I say that every meeting, but it still holds true. Just let us know. So Ed, the floor is yours.
Thank you. Good morning, everyone. Can we have the first stage of the presentation, please? So what you see here on the screen is your current asset allocation. So it was approved by the board 2018, it was implemented 2019. And I hope this chart is familiar to everyone. So it's a broadly speaking blend of 13 asset classes split between public and private markets. The process of creating asset allocation goes through 2 steps, broadly speaking. On the first stage, we'll formulate so-called capital market assumptions. And clearly, we're trying to build something for the future that is unknown and unknowable. We don't know what the returns will be. That's as we make an educated guess, and by we, I mean Wilshire, makes an educated guess on the future returns across all asset classes, the volatilities and correlations. The process to generate capital market assumptions is really a blend of art and science. Right? It's science in the sense that we rely on the established historical track record. We know what asset classes returns, and we know that over the time markets tend to mean reverse. It's also a bit of an art because the markets today will never appear with markets used in the past. We, in a different environment, and the future will again be somewhat different. So it's kind of all brought together through the formulation of asset capital market assumptions. And the next step in the process will be to run so-called optimization, which is a statistical technique where we look across all asset classes and determine the allocations. So why are we talking about this today, now? First of all, we obviously went through a very unusual period in history, through the inflation, through war in Europe, which created enormous dislocation in the market. And as we talked to many consultants across all 5 systems, I think the general message is almost all of their clients now going through this asset allocation exercise, just because of the changes happening in the world. I would say we are in a somewhat unusual and privileged position where we have 5 systems under the same roof, where we can kind of compare and analyze a broader range of application and split in a broader perspective. And of course, there's another reason why we do the application now, and that's the change to the basket clause. Can we have the next page, please? And I'm sure everyone is familiar with this legislation from 1960s, which has been a constraint on the investment process. So what you see here on screen is the calculation for the basket utilization at the end of April. So you can see it stands at 24.1% versus the old limit 25, which obviously currently relaxed to 35%. And here you can see how we came up with 24%. And there are 3 types of assets from the point of view of basket clause legislation. Assets exempt are labeled in green color, non-basket assets. And that's broadly speaking public equities, domestic public equities. So it's listed stocks and bonds that have ISIN. The foreign equities are exempt up to 10%. And by foreign, we mean here developed ex-US plus emerging markets. So you can see that currently we use 3% towards the basket utilization.
Yeah, and it's on that.
High yield also exempt up to 10%, and that's where we have a lot of cushion. The current utilization is 4.6%. And finally, the alternatives, that's where most of utilization takes place. Obviously, private equity, private credit, and hedge funds count 100% towards the basket clause. And real assets, defined as the sum of infrastructure and real estate, exempt up to 10%. You can see altogether it's 24% as of end of April. As a matter of fact, as of this morning, the utilization stands at 23.7%. So currently, we obviously have more breathing room. We can go up to 35%, which is to say flexibility is not a must. We don't have to go there, and part of the application will determine the most optimal allocation. Some preliminary indication what we've seen so far, we're far from being done. Because of the repricing in public markets, specifically fixed income, there may not be need now to go all the way to the edge of the basket. But that discussion will happen in a few months.
So maybe just a comment, the basket assets are not necessarily basket case assets. Someone had asked me that question in a prior meeting. It's actually, we have a legal list that we work off of, and whatever doesn't appear on the legal list falls into the prudent investment basket. That's why it's called a basket clause. I don't want to give anyone the wrong idea that these assets aren't of quality and merit.
Would be investing in them otherwise. So the rest of the presentation will go through 3 stages. First of all, we will look how the average capital market assumptions, average across 5 systems, compared with the realized performance of the market. The second step will see how the previous assumptions compare versus the current crop. And finally, the last step is probably more of an interest. We'll see how the 5 systems compare to each other. We'll look at the dispersion. And here, we're not trying to push back or dispute or discuss it clearly to identify the outliers. It's more a kind of food for thought and setting the baseline expectations rather than desire to fight different problems otherwise.
More for informational value. We're not asking anyone to change their assumptions. No one has a crystal ball. As Ed said earlier, we don't know what the outcomes will be in the future, but just a part of a point of analysis.
So can I give it the next page, please? Thank you. So here we'll be looking at how the previous assumptions, formulated 2018, implemented 2019, how they compared with the realized outcome. And a huge disclaimer to mention here, obviously the assumptions are formulated for the 10-year horizon. It's been about 4 years since the implementation, so there's more time to run, and the outcome is still, you'll see some dispersion between the assumption and the outcome. We still have 6 years to go. So what you see on the screen at the top, all pages structured the same way. The top row of the chart shows the performance expectations. The bottom row shows the risk or volatility of returns. And we start with public markets. So starting with public equities, chart number 1 in the upper left. Here you see the gray bar represents the average across 5 systems, the average assumption across 5 systems. The light orange bar represents the public market outcome, which is broad market indices. And the dark orange bar represents your manager's actual performance. Starting with US large cap, so you can see that you can say the assumptions are conservative, or the outcome was still up to above expectations, but clearly US equities delivered the performance far exceeding the expectations. And that's partly a reflection of fairly extraordinary periods in the markets. But also, if you look at the assumption of 5.8%, that's not far from the long-term performance of US markets. Developed world ex-US, the next leaf, again, the outcome exceeded expectation, maybe not as much. Emerging market was probably the only market that met the expectations. So obviously, developed markets outperformed the emerging market, you can see clearly. And on the risk side, that's where it's easy to forecast the risks. They tend to mean revert quite fast. In the normal market environment, these tend to be fairly steady. They spike in the crisis environment. You can see that the assumed risks were more or less in line with the realized outcome, except maybe for the emerging markets, which was a little bit disappointing. The picture is somewhat different for fixed income. So clearly, we're still going through a period of high inflation, which hits predominantly fixed income. And you can see chart number 2, the assumption of 3.4%, not far from historical average, clearly didn't meet the realized outcome. And I forgot how many 100 years counts towards the exceptional fixed income returns, but it's hopefully none of us will see it again in our lifetime, maybe not even our children. The outcome was well below expectations, and the risks were well ahead of expectations. At the same time, high yield, and that will be the message I keep repeating through the presentation. To me, high yield is more like a golden child. So you can see a fairly steady nature of this asset class. You see that the returns beat the expectation, but not by a huge margin, and the risks were slightly lower than expectations. So it's a good outcome. It's a very steady asset class, and we'll see it again in a private version as well. And the last point I'd like to make on this slide is your manager's performance. And it was very helpful. Again, we went through a very extraordinary period in time. Even US large cap, where you see the majority of US large cap is indexed, you don't see much of action. But developed world ex-US delivered very strong performance. Emerging markets delivered strong performance. High yield, core US, core fixed income US. In all sleeves, your managers helped and delivered a positive outperformance. So it's definitely a positive outcome. Moving towards the alternatives, have the next page, please. I would say somewhat similar picture. In terms of performance, private markets outperformed the public markets, maybe not as much as we expected, but nevertheless delivering a positive alpha. The expectations were higher, the returns were higher, and it goes across all sleeves: private equity, private infrastructure, hedge funds. Just a word of caution on risks. So you can see in chart number 3, you see how much higher the gray bar is, right? And that's an important point. We'll be talking about it through the presentation. We tend to talk about volatility as a proxy for risk, and it works reasonably well in the public markets. That is not necessarily so for alternatives. And part of it is just because the marks are observable only 4 times a year, the quarterly evaluation, which tends to suppress volatility, mathematics of it. Part of it is certain degree of smoothing by the managers. But we tend to think of volatility as not a good measure of risk, and I think across all 5 general consultants, there was high degree of consistency in this messaging. So that's why, like a standard approach is to use modeled volatility as a proxy for risk rather than observable. That's what you see on this page. This 26.5% assumption, that was the modeled volatility, and the realized outcome, 21.8, was much lower. So it's only to be expected we'll see it again in the current crop of assumptions. But broadly speaking, I would say the outcomes you see for alternative assets broadly mirror the outcome for the public markets with an addition of liquidity premium. So no huge takeaway from here, everything worked out as expected.
So just one question, and going back more to, I guess it applies more to the public markets, obviously. Volatility isn't that the area where we're seeking some return on, let's say, the hedge fund portfolio, right? Is that where we're picking up some return on volatility?
Hedge funds, it's a very broad bucket. I would say the answer is yes to a subset of hedge fund strategy, but I wouldn't make it as a universal statement across the board.
Okay, fair, okay.
Okay, and please have any questions, stop me anymore. Moving on towards the comparison of previous vintage versus the current capital market assumptions, and the next page, thank you. So what you see here, the gray bar represents the previous set of assumptions from 2018. The black bars represent the average across the 5 systems of the current assumptions.
And we should also mention that the assumptions from all the consultants are 10-year assumptions, and this is only a 4-year period, a little less than a 4-year period. So it's not really an apples to oranges comparison, but it's the best one we have.
And again, at the top of the page, you see the returns, at the bottom you see the risks. So I would say the first thing that jumps at me at this page, it's more about evolution. And that's something you would probably expect, right? So we're talking about 10-year long-term assumptions. They tend to incorporate the price history of 50, 100 years, depending on the system. So you don't really expect huge jumps. So if you look at page chart 1 and chart 3, the risk and returns for equities, it's priced slightly higher, but I'm not talking about dramatic moves. So I would say it's broadly consistent. And just, I think it's helpful to put it in a more long-term perspective. Like, for example, you see US large cap, the assumptions move from 5.8 to 6.7. The 50-year return for the S&P was 7.5%. So we're still slightly below the long-term averages. For developed world ex-US, the long-term performance of this market was 5.9%. So yes, we're slightly higher. But broadly speaking, we're in line with long-term history, in line with the previous assumptions. It's a little bit different on the fixed income side, right? So if you look at chart number 2 in the upper right corner, you see that fixed income, broadly speaking, is priced higher. And I hope it's not a surprise to anyone, given what's happening with rates. You see the assumption for US Treasury is making the most dramatic move. It's probably one of the most important rates globally. It's a benchmark for all rates, almost every country. And it's not surprising that the assumption moved from 2.6 to 5.9%. I'm sorry, 3.9%. It's a big move. And the risks at the bottom, chart number 4, again, you can see that risk assumptions move significantly higher. It's entirely consistent with the current market. US core, fixed income, again, the return assumptions moved higher from 3.4 to 4.4%. Again, the long-term, looking for long-term lens, the 50-year returns for core fixed income is 6.6%. But again, this is coming from the post-Volcker era of rates taking 20%. We don't really expect the rates to repeat that impressive run. And again, high yield, moved slightly higher. But look what's happening with the risk assumptions for high yield. Very steady. That's again back to my point that high yield is probably one of the most steady asset classes out there. Moving towards alternatives, okay, next page, please. Again, there's no big takeaway, and it's not necessarily a bad thing, right? So you can see consistent with public markets, private equity moves slightly higher in return, risk assumption about the same. Infrastructure, let's call it a tie. A little bit more action on the private credit side. The only noteworthy observation here is core real estate, moves slightly higher, and that's really a reflection of an outstanding performance of core real estate in the past few quarters. So it's only logical to expect the performance going forward to be slightly lower. But again, no huge takeaway, which is not necessarily a bad thing. So moving into the next session, the next page. For a lot more interest, and that's where we'll look at the assumptions. We compare the assumptions across 5 systems. And that's somewhat unique in our presentation because normally we talk about a lease portfolio in this session. So here we talk about all 5 systems and all 5 consultants. I think it's an interesting point of comparison. So what you see here are the 3 fundamental building blocks. These building blocks are defined as the assumptions for all other asset classes. So first of all, inflation. And obviously in the current environment, it's probably the largest wild card, the largest uncertainty, and the biggest unknown. That said, you can see that across all 5 systems, chart number 1, the expectations are very similar. This little dispersion. And that's probably not that surprising given that almost everybody's using the same set of inputs. It's the forward curve and the dot plot from the Federal Reserve. So you can see that everybody expects the long-term inflation to move down closer to the Federal Reserve target range of 2%. That said, given a fairly uniform block of dispersion for inflation, when we look at the cash returns, chart number 2, that's where we see a lot of dispersion. It's actually important because it will reverberate through all our assumptions. So you can see, and you can see why having the same assumption for inflation produce such different assumptions for cash returns. The answer is all about the path. It's how fast we expect the inflation to come down. So if we assume inflation staying high for longer, coming down for the 10-year period, you expect cash rates to be higher. If we expect inflation to move lower right away, we expect cash returns to be lower. You can see Callan is probably the most optimistic in terms of the path of inflation. They put the cash returns to 2.8%. Wilshire, please jump in with any comments on Wilshire. Expect inflation to stay a little bit higher, much like NAPC. But it's an important chart to keep in mind because it will explain a lot of dispersion across all other asset classes. And finally, U.S. Treasuries, again, one of the most fundamental inputs for all asset classes, chart number 3. A little bit more uniform, and that's simply because the forward yield curve, it is what it is. It's observable. It's one of the most important inputs. These are assumptions. Maybe Wilshire is a little bit on the high end, but again, we're not talking about huge dispersion. Broadly speaking, everybody is on the same page.
I had a question about that chart. It's interesting that the cash return expectations is in some cases parallel to the U.S. Treasury return assumptions. I don't know if this is a silly question. What kind of volatility do you see in cash?
Right now or historically? So that's a good question.
Yeah, I mean, yeah. If the returns are the same, I'm curious about the differences in the volatility. What moves it?
I think the differences here have to do with the path that you get to the lower levels, the path of interest rates over the course of 10 years. I think that's what drives the differences in the cash return assumptions.
We don't have a chart on,
I will tell you. That's fine, we can move on.
do you mind if I come back to your question in 2 minutes?
Yeah, sure.
Because we have a chart to address it, but, here's how
You understood the question.
yes, I'll just question in 2 minutes. So moving towards, public asset classes, so can I have the next page, please? Starting with equities. And again, so what you see here, the top row refers to the return assumptions, and the bottom row refers to the risk or volatility assumptions. Both are important for the next stage optimization. And let's start with U.S. equities, chart number 1. So that's where we look at the assumption for U.S. large cap for the S&P 500. And that's probably one of the most important asset class for the asset allocation. So U.S. equities is the single largest allocation, and obviously large cap is one of the most important indices out there, most important asset classes. I would say there's a fair degree of dispersion between the systems. You can see that Wilshire, again, I don't want to speak for us, but if you have any questions, it was a joint presentation. Wilshire ended up like right in the middle of the range at 6.5%. NAPC obviously was a little bit more pessimistic on the assumptions. But the difference in returns and risk assumptions, chart number 4, will have consequences for application. So again, clearly for Wilshire, it's in the average for both risk and returns. I would say the same goes for developed world ex-US. It's all consistent. The only probably noteworthy observation here is in emerging markets. That's where Wilshire came slightly lower than average. Again, slightly is the key word here. And the risk maybe a tad above the average, but again, we're not talking about enormous shifts. Moving on to fixed income. Next page, please. Again, the same idea. We have returns in the top row and risks at the bottom row. First of all, US TIPS, clearly interesting asset class in the current environment. Despite the uncertainty about the rates and inflation, you see that all 5 systems put TIPS at about the same level of returns and risks. Very little dispersion. It's important to notice that the returns of US TIPS are comparable to returns on cash. We'll see the importance of this in a few minutes. US core fixed income, that's where you see more dispersion. And that's, again, not surprising given the uncertainty in the fixed income markets, right? So again, we're talking about once in 200 or 300 year events. I forgot how many 100 years, but it's a very unusual market. I would say probably Wilshire is slightly above in terms of return expectations. You see Rocketon, which is teachers, consultants, probably the most pessimistic in terms of returns. And that's where I come back to your question on this. So you can see volatility of US core fixed income, which is probably the best proxy we have for cash volatility. These are actually whether it's current or before. The volatility in the fixed income markets is through the charts. If we use the MOVE index as a measure of volatility, it came down significantly since the peak about 6 months ago. That's it's still running at a very high level. Historically, the volatility of cash was almost non-existent. We expect this to revert to historical mean in the future, but we are still in a fairly unprecedented times.
So in that case, you're getting fairly better risk-adjusted returns
From cash?
from cash.
For now, yes.
So can I ask you, because much of this is above my understanding, so I'm going to question you just a couple of things. So U.S. TIPS, the idea is that they will give us a return based on inflation, right? And inflation-protected securities, right? So inflation, let's say 3%, I should be getting slightly more than 3% from TIPS, right? Or a little better.
slightly more complicated.
Yeah, I get it. Everything's more complicated.
Yeah.
Let's keep it at my level, okay? All right, so I should be getting something slightly better than inflation, right? Okay, so if Rokutan is showing 4.3% on, that's gonna be based on inflation, right? Somewhat, right? That's a tip, right? But volatility now going down, Rokutan saying 6.1. So that's gonna be the dispersion, basically, of where I should be, to be 6.1 above or 6.1 below, right? Okay. Now I go to US core fixed income, okay? The Rokutan is showing 3.8. So they're showing slightly lower than inflation of what they're predicting on a US tip, okay? So what should I be taking from that? And of course, they're showing fixed income. Obviously, the dispersion is going to be less than, they're showing less than what Rokutan is showing on a US tip in volatility. As a trustee now, okay? I'm asking you to think as a trustee, not someone who's in the woods and you know, what am I supposed to take from that with regards to the prediction of inflation going forward and a portfolio? Now, of course, I'm only talking about fixed income. I don't want to go through every chart on, you know, but just at this level, what am I taking from that? Of course, high yield will have to give me better than inflation, right? Although I'm sure it's more complicated than that. But that's the point.
With if you make it too complicated,
Let's try to keep it simple.
Very simple.
I'm a simple person.
I think one key sentence you just said, that if inflation goes by 3%, you expect a 3% return from tips. And that's why I said it's slightly more complicated than that. So you have two kind of two processes, right, that's trying to fight each other. It's inflation and interest rates.
Interest rate sensitivity.
And of course, when inflation goes up, we have very predictable response from the Federal Reserve.
So there's a stickiness to that somewhat, right?
There is, but there's also, inflation is not such a simple measure. The way to think about tips, you get not necessarily the inflation today. Tips return the inflation expectations, the 10-year inflation expectations. So when you say inflation goes up by 3%, the real question is how much inflation expectations will move.
Right, so today, it may be showing, maybe inflation's at 6%, but the expectation is really that it should average out to 3.5% or whatever.
3%, yeah.
And I should be getting 3.5 or slightly better than that.
And then you're getting killed on duration because those interest rates go up.
Right.
So that's like.
And the longer it goes out, the worse, because inflation wrecks everything.
That's what hurt the returns on tips last year. They have a duration exposure, so tips were off over 6 to 7%. In a year where you'd say, well, if inflation's the driver, why wouldn't it outperform? Technically, it did outperform core, but it still delivered a negative return for the year.
Would that be the same case for U.S. core, let's say fixed income, a duration issue?
Yes. So to like the yes,
So from the tips, they're expecting 4.3% on average, but U.S. core, they're expecting lower. Are they the same duration?
Not necessarily.
See, that makes it complicated for me.
Yes.
You know, when you're sitting here and you're taking this information in, you have to look at, it's like an apples to slightly an orange kind of, a tangelo kind of routine. I have different.
It is, and that's actually one discussion we.
Like that, right?
It's one of the actual discussion we have at BAM. So, Mike, to your point, the duration of tips is one of the levers, one of the dots we can firm. So it's within our power to change the duration of tips. So that's one discussion with the consultants, how to rebalance tip allocation. What's the best inflation protection? Because tips definitely provide inflation protection within the fixed income allocation, but not necessarily at the portfolio level.
Rob, do you want to?
Yeah, I just want to add a comment. I think a lot of this presentation is just about the building blocks of the asset allocation study, but when we actually put the study in front of you and make a recommendation, it's going to be based on the total mix of assets, public equity, public fixed income, alternatives. whereas you start kind of comparing individual asset classes, it's really easy to say, well, is TIPS more attractive than bonds? Or is stocks more attractive than bonds? Where are we going to be at inflation? You put them all the assets together, you look at where you are in the risk spectrum, making sure you have sufficient liquidity, and finally, the basket clause. I think that's when you can make a more informed decision and say, how do all these move together? Because you don't have to
We always have to figure out all.
yeah, it
those
doesn't have to be
parts.
mutually exclusive, that it's either TIPS or fixed income, or it's more high yield or fixed income. It's just sort of putting everything together. But at least the point of this is saying, you know, if I was looking at this, and I want to be careful about my comments on other consultancies in a public, you know,
We
session, but
understand. That's another
Yeah,
aspect to this
right.
that we don't want to address, but it is the elephant in the room.
yeah,
You have differences of opinion, that's why it's reflected here.
yeah.
Differences of opinion.
Most of this is, I think, that most of the general consultants are in line. There's a few outliers here and there,
Mhm.
and there can be specific questions about those that we're happy to address, but
And I'm sure there will be.
to me, this, the takeaway from a lot of these slides is it's pretty consistent across the 4 or 5 plans, with the exception of a few asset classes.
That's an end.
But it's also, and I'll be fair, it's also good to see that even though those consultants don't sit on this fund and don't help guide the information here, it's good to see where everybody is. However, I would also say that each fund operates within its own, system, and they will make the best decision for the beneficiaries of that specific plan. As a former predecessor of yours, Steve, like to come up and say, well, we're all basically the same, and I'm like, no, we're not. We're not, and anything to the contrary, I would say, you know, if I get 5%, I'm sure fire wants 6% or 7%. We should all be looking to be natural competitors, trying to get the best for the beneficiaries.
There's nothing the same about you, Joe.
Okay, I think that is true, and we recognize and appreciate the uniqueness of each fund, the preferences, the risk tolerance, the funded ratios, all that goes into the mix. Rob actually made a really good point about how the assets move together once they're put together in a portfolio. The one thing that's really not addressed here is the correlation of assets. And it's just a fancy way of saying that stocks are at 1% and bonds are up 0.75. They only move 3/4. They have that sensitivity, that correlation. So that'll all go into the mix when Wilshire runs their optimization as well. We thought this was interesting only because we found it intellectually.
No, it is
interesting.
intellectually interesting to understand, again, you know, what will be the assumptions and what are the slight differences in the assumptions across various plans, and obviously, we're seeing some of that, so.
And I'm very respectful of the individual general consultants. No one has a crystal ball. The idea isn't to browbeat everyone to go to the average rate. It's really just to try to understand the context of everything.
I would say that it's Nostradamus-like, so. But hey, this is what we have.
Yeah.
This is the system we have, so. Okay. Thank you.
All right, so, moving towards, private assets. Can we have the next page, please? Okay, so, the same, we just talked about for, private assets. So you can see for private equity, the return assumptions, low dispersion, again, Wilshire came exactly in the middle of the range. We see more action, chart number 4, the risk or volatility assumptions. Just I mentioned before, it is consensus across all 5 systems to use a model volatility instead of observable volatility. It's usually done as using public market proxies. Given it's modeled, it's not surprising to see some degree of dispersion. And that's where Wilshire came slightly on the upper end of the range. Again, we're not talking about huge numbers, but nevertheless. So consensus returns like a low volatility will probably slightly disadvantage private equity in asset allocation. The only notable.
One other comment, it's interesting to me too, that if you look at public market equity, average returns is 6.7. Private market equity, or private equity, actually comes in at 9.7. That's basically the 300 basis point liquidity premium you spoke about earlier at the outset.
Right, so it's consistent across all 5 systems. Probably the only noteworthy observation on this page is chart number 2, when talking about infrastructure. I was actually surprised to see such a broad range of dispersion for infrastructure, because it's a fairly steady asset class. And that's where I would say Wilshire probably came a bit of an outlier. with returns, lower than the average and the risk assumptions, materially higher than the average.
Would it be fair to let Rob, if he wants to address that? or-
Yeah,
Yeah, it's this time to hear it.
Yeah, this is the area where I think Wilshire does stand out as a outlier, more so on the volatility. We are a bit light on the return, but I don't think that we're, some broad measure of standard deviation away from the median return. And the volatility really is a function of, realized volatility versus, the volatility inherent with, leverage and these types of illiquid investments. So I think Ed was sort of alluding to this earlier when he said, you know, we assume a much higher volatility for private assets or private equity infrastructure, but you may not realize that in your actual quarterly performance reports because those values are not marked to market as often, and those values are also lagged. Oftentimes they're lagged 6 months. And so we're trying to give our clients more insight into what we think the realized volatility would be if you made some assumptions for those limitations of the asset class. Now, is it worth 1,000 basis points more for those limitations? We can have a debate about that. And I think one thing that we're trying to be a good partner with the BAM and the trustees is we can look at a version of the asset allocation study that uses the Wilshire assumptions, but also stress test that a bit. What would that look like if we reduce that volatility, you know, slightly and we're more in line with the other consultancies? Not saying that that's going to be the tail that wags the dog in any way, shape, or form, but just to be fair based on the analysis and the other feedback that we're seeing, and quite frankly, the attractiveness of the space. I don't think we're going to argue with Ed or Steve or Petya about some really good private infrastructure opportunities that will be coming from managers. And so the last comment I'll make is this is all based upon the asset class. We are not making any kind of assumptions for what active managers would do in the space. And we know that in alternative investments, most notably, active management is the critical decision. It's not how much you have in private equity, it's the private equity managers that you select. And so when you see like our assumption for private equity being 9.9%, I don't think there's been an investment manager that's come through this boardroom that is underwriting to a 9.9% return. Most of those returns that they're seeking are 12 to 15%, and that's because they believe they have the skill and the expertise to do so. And so I think you have to kind of separate the asset allocation study from what you might actually realize in your performance report.
So the reason I asked this, only, Rob, to bring this up, and again, based on my former comment about each fund being different and the consultants, and this is why we have separate consultants, and I think, Rob, and I'll say for myself, you do an excellent job at helping to guide our decisions here. Difference between, let's say, one consultant and Wilshire here, while it doesn't seem a lot to the average person, it's a 60% difference in terms of the actual projection of return. And so you need to have that explained. And obviously Wilshire, will have that fight in private and of course in consulting us down the road. Why one consultant on another fund is 60% higher than what Wilshire's predicting. And again, these are things that will have to be addressed as we really heat this up, as you guys really heat this up.
And Joe, I think it goes without saying, but I'm sure the mayor's office feels the same, Mopi feels the same, but we look at each of the 5, even though we sit on multiple boards, we look at each fund through the lens of that particular board. So we're not in favor of a one-size-fits-all strategy in the control. No, I'm just saying for the controls, I think it's important for the
I want to be clear, that's not what I'm saying. It used to be kind of a thought that was brought out.
Yeah.
I'm not saying you're doing that.
No,
I want to be clear on that. But I do want to express that it's important here that while it may seem to the average person out there, well, it's only a difference of 3%. No, that 3% is over 60% difference.
Yeah.
And you need to express that and say, why is there a 60% difference in the way one consultant sees it as opposed to another consultant. That's important to
No,
know.
I agree. I just wanted to make sure that for the thousands or the hundreds of people that are watching, that they.
Thousands, I would say the 3 people that are watching, let's get that straight. And some of them are in their holy underwear. But I would just say, for the individuals who deal with numbers all the time, that sometimes gets lost.
Yes.
But for persons who are gonna make decisions here, you know, a 60% difference is quite a
Yeah.
large number. You know, it's not just 8 versus 5, it's quite a bit.
I'd just like to, you know, I appreciate your comments, Rob. I do think the comparison's interesting, and I do think what you said about infrastructure is true, and, you know, the fact that you're looking at leverage too. I do think generally volatility is understated, moving in and all. And I think you're right too, like, in terms of how the portfolio construction is on each asset classes. Not only to the managers, but, you know, what the particular portfolio construction is by sectors and so on.
Yeah, and I'm happy to go more inside baseball, like in a caucus or something, if there's more specific questions, but my last comment would be, you know, with the orange line, because I've had these conversations for years with different clients. This comes up every now and again, as you might expect, sort of comparing Wilshire's assumptions versus competitors. We even shared with BAM a broader survey that had like 30 firms in it, you know, just for more data. You always, this is my own personal view now, you always don't want to be too far off the orange line, right? Because you want to show that you have a consistent process, but you have to balance that, because I never want my firm to be always on the orange line too, because that means we're just doing groupthink and doing the same process as our competitors. So I don't want 20 outliers, but I also don't want 0. And so I think it's important that you're getting, you know, independent advice.
What's the line? If everybody in the room is agreeing, only one person's doing the thing.
Right.
I prefer that everybody be slightly different.
Right, I did also want to add that also from the mayor's office, I respect every consultant in terms of how to work with each fund.
And that's been my experience with BAM as well.
Yeah. And I also, started doing that, we also respect the comparison, because it helps understand the consultants as we talk to particular funds.
Okay, so moving along to the next page. And yeah, so finally, so far we've been talking about the 5 consultants, but of course we have more. And here we're being the specialist consultants. You see specialists in the orange bars. And it's probably not a shocking statement that specialists see, generally speaking, see the returns for private assets higher and the risks as being lower. We had several discussions where we brought everybody together. And I think the next was everyone agreed to disagree. I think the fundamental difference that specialists see volatility as an observable parameter. They just measure it is what it is. And I think the general consultants see it more as model input as we discussed. So there are no huge takeaways here. And finally, moving towards the second set of alternatives. Next page, please. Thank you. So we look at private credit and real estate. Again, I would say no huge takeaways, which is not necessarily a bad thing for this group. If anything, for real estate, Wilshire came slightly below average, but again, the keyword here is slightly. I wouldn't necessarily question. Private credit, almost exactly in the middle. And again, just Steve mentioned, private credit here, the average gains the illiquidity premium. It provides a premium over a high yield. And finally, just to bring the specialists into the picture, the next page. Again, thank you. Similar pictures, the specialists tend to see the returns being better and the risk being lower than the generalist consultants. Again, not a huge surprise here. Okay, and finally, I think an interesting point, kind of bring it all together. The next page, please. Thank you. When we look at the Sharpe ratios, and just a reminder, the Sharpe ratio is just It's a simple ratio. In the numerator, you have the excess return over risk-free rate. In denominator is the increase. And a useful point of comparison is keep in mind that the long-term Sharpe ratio of U.S. large cap, and by long-term I mean close to 100 years, is 0.37. So to me, 0.37 is a useful point of reference. And as a matter of fact, it happens so that almost all asset classes have long-term Sharpe ratio in about the same range. So it's 0.38 for high yield, 0.40 for government bonds. And the way to think about it, the Sharpe ratio gives you the excess return per unit of volatility. So a Sharpe ratio of 0.37 simply means that you're making 37 cents for every point of volatility. So with this in mind, if you look at the charts here on this page, we show you Sharpe ratios across public asset classes. That's where the differences come more to the foreground. If you look at U.S. large cap, we see a bit of dispersion. So first of all systems see the Sharpe ratio being below the long-term average. Again, so you see the average is 0.19 versus long-term Sharpe 0.37. Wilshire came slightly probably below average, not dramatically. You see NAPC is a much larger outlier, and Callan's probably more aggressive side. Developed world ex-US, again, very similar picture, and finally emerging markets where Wilshire is slightly more pessimistic. The important point to keep in mind when we make this comparison, it's not to compare Sharpe ratio within asset class, it's to compare Sharpe ratio across asset classes. So from this perspective, you see Wilshire is consistently positioned across US large cap, developed world ex-US and emerging markets, meaning that the resulting end allocation for Wilshire is probably very close to an average system, right? If anything, I would say NAPC is an outlier here where emerging markets is significantly higher. It gets more interesting for US tips, and that's where Joe's comments from earlier becomes more interesting. I almost want to jump to the page. And if you remember a few minutes ago, I said that there's almost no dispersion for tips, be it either in returns or risks. And yet here we are, chart number 4, probably the largest level of dispersion anywhere. And the simple answer to this question is the cash returns. So the returns for tips are fairly similar to cash returns. You take the difference, you end up with small numbers, and for Wilshire, it turns out it's slightly negative or close to 0. But again, we're talking about very small levels of excess return, which is the key question. And that's one of the discussions we'll be having at the next stage of application. We'll talk about the results and optimization, the role of tips with all the comments that Joe made previously. I'm not going to repeat them. Similar to tips, US core fixed income, again, we see a large degree of dispersion. Again, not surprising given a fairly unusual market. Again, Wilshire came exactly in the middle of the range. If anything, Callan is an outlier here. In high yield, to me, is the most interesting chart, the chart number 6. That's what my notes from earlier before. It's one of the most reliable and predictable asset classes out there. You see that's probably the most agreement we see across all systems, was at high yield.
I have a question on this chart, maybe it's for Wilshire as well. To what extent could differences in risk-free rate be accounting for differences in Sharpe ratios between the managers? I'm just wondering, does everybody consistently use the same? What do you use as a risk-free rate?
Just to comment on that, we almost didn't have a risk-free rate a couple of weeks ago, considering Congress's behavior.
Yeah,
exactly. So just remember that.
I think it's a critical, sorry.
I mean, when we actually do use Sharpe ratios here, we will be using, just to compare portfolios that you will be presenting. So, but there, I imagine the portfolios have the same risk ratio, but across them, they'll probably be different.
So I think your specific question about are the Sharpe ratios different because the risk-free rate is different, I don't think you're going to see a material difference on how Sharpe is calculated based on the risk-free rate. It's pretty straightforward, and most are going to be very marginal differences of what you're using for the risk-free rate. What is different is the numerator and the denominator. Okay, so the numerator is your expected return, and the denominator is your expected risk, and Ed just walked through all the differences among the consultancies about those two numbers. So if you take one and divide it by the other, and those two numbers have disparities among the consultancies, you're gonna have disparities among your Sharpe ratio. That's what you're seeing there. But I think what I'm seeing on this chart is assumptions by consultants compared to historical results on the orange line, right? And depending on that time series, you're gonna have pretty unique differences in what the risk-free rate is, because over the past 3 years, we've had historic changes in the risk-free rate, and we've also had a global pandemic and keep going. And so that's why it's a very difficult comparison, but this is the sabermetrics now of investing. It's like, is a guy a good hitter because he's got a good batting average, or because he's got good on-base plus slugging percentage? Well, is he hitting for contact, or is he hitting for contact and power? This is why this table can be a little bit confusing sometimes.
I like that, sabermetric.
Yeah.
Conversation. So,
And
you're
interest
saying,
rates have been artificially suppressed, given, coming out of the pandemic, coming out of the global financial crisis. One of the things that Ed said earlier when we presented, at the start of this process, that a lot of these assumptions are backward looking. We try to look forward through weighting schemes, but if you look back over the last 25 years, it's been a very challenging time. We've had the dot-com bubble burst, we had the global financial crisis, we had the European sovereign crisis, we had a pandemic.
don't forget the
ground war in
accounting
Europe.
scandals.
Right.
Don't forget that too, that gave us headaches.
All that good stuff,
So when we first went over these slides with Ed, we were joking. I said, I'm sorry I didn't predict 18% returns 4 years ago during the, the global pandemic. So you have to take some of these assumptions versus historical results with some context.
So I'm mindful of time and the fact that we have a very hefty executive agenda. So I appreciate all these comments, but I just want to make sure we keep moving in the right direction in order to accommodate the investment managers that we'll be seeing in the second part of this meeting.
We're almost done with the presentation, just, 1 minute, more, get next page. Here we'll bring, the Sharpe assumptions for especially consultants. And, I wish we could promise you a Sharpe ratio of 1.2 for private infrastructure. I'm personally a little bit skeptical about that. But again, this is more a point of reference. This is not what will be used for the application, because obviously general consultants are responsible for the application. And just last point I want to make, this also appendix to this presentation where we show the dispersions and correlations. And remember, there are 3 main inputs that go into optimization. It's the returns, the risks, and the correlation. Probably it will take too much time to go over everything, but it's there for your reference. Of course, happy to answer any questions.
Okay, so if
So
there
there'll be a lot to talk about.
yes, if there are additional questions today, we're happy to take those. If not, like I always say, Ed is available between meetings.
You could get them, you'll be getting access.
And if anybody that doesn't have access to any of this information, we'll make sure that your passwords are up to date and provide that to everyone. So we have one more item in public. Ed's going to give us Steve rather, is going to give us a high-level look at the quarterly and give us some commentary before we move into executive session. So, Steve, it's up to you. You're the next up. And then
There'll be 2.
Joe, I know, I thought that was going to be a surprise, but okay, we have two items.
So I'm going to give a Reader's Digest version of a quick update, just on what's going on in the economy in the first quarter and where we are now. There's a reason why we did this in this order. We think that obviously the strategic asset allocation is a really important decision, which is why we've prioritized Ed's remarks versus mine for today. But maybe just, Kate or Wilfredo, if you go to the next slide, please. Just a quick look at what's going on in the economy. Obviously, inflation continues to be a challenge around the world. Less so in the States. We've basically cut our inflation levels measured by CPI by more than 50%. The core PCE deflator is still somewhat sticky in the mid-4s, which is a challenge for the Fed and other central banks around the world. On the next slide, just a quick look at the core PCE deflator at 4.6%, which has been fairly consistent over the last year in the mid-4s. And you can see that the core CPI actually peaked in June of last year at 9.1%, and more recently it was at 4%. So some good news on inflation, but still well above the Fed's 2% target. as well above the Bank of England, and the ECB's targets as well. And the next slide is a quick look at inflation around the world. You can see on the far right-hand side the direction that we've seen inflation pull lower. The U.S. represented in red, again, at just over 4%. Europe continues to be somewhat high at about 7%. And UK inflation is very stubborn. You can see that gray on the upper right-hand side. They actually had a little bit of a step back. Inflation picked up, but it's now starting to move lower again. On the next slide, employment. Employment in the U.S. continues to be very strong. Over the last 3 months, we've had over 300,000 jobs created on average, well above what the Fed would like to see or expect. In order for the Fed to bring down inflation expectations, the thinking is that those job increases need to be less than 100,000 on average per month, and it's significantly higher. Job growth remains particularly strong in the service sector, and we are seeing, continued resilience in the unemployment level. The unemployment rate, however, in May did tick up from its 53-year low of 3.4%. It is now at 3.7%, so moving in the right direction. I said the other thing to note around the employment picture is that jobless claims more recently, on Thursday, have been trending higher, so perhaps the Fed rate hikes are starting to bite, and more people are being displaced from jobs, which isn't a great thing, but I think it's what the Fed needs to see to slow the economy. On the next slide, again, a look at the unemployment rate on the far lower side in white, 3.7%. The participation rate has actually moved up higher than it had been during the pandemic, but not nearly as high as it was, still about 1 point below where it was pre-pandemic. So more people have to come back into the labor force as well. On the next slide, a quick look at economic growth. We saw first quarter GDP growth in the States come in somewhat tepid, 1.3%. That was an upward revision from 1.1%. In Europe, they're technically moved into a technical recession in two quarters with negative GDP growth. On the left-hand side, you can see that Asia poised to drive global economic growth higher, boosted by China's reopening. China has reopened. The expectations were anywhere between 5.5% to 6% GDP growth. It has underperformed those expectations, coming in just below 5%. And more recently, last week, China's central bank was reducing official interest rates and taking other stimulative measures to promote economic growth there. On the next slide, just a pictorial look at that. On the far right-hand side, you can see everything's kind of clustered down towards the 1 to 2 to 3% growth rate. China's this slight outlier at just under 5%. U.S. GDP at 1.3%. UK is flat. And as I mentioned, the Eurozone is actually moving into a technical recession with negative GDP growth. On the next slide, something that's more close to home, the return to work process has been very slow, people getting back to their offices. In New York City, office utilization rates are at 48% of pre-pandemic levels. That's a messy chart, but you can see that on the headline on the far right-hand side. If you have the courage to try to discern the blues, we're just at a little under 50% where we had to be pre-pandemic.
By the way, I find it difficult to return to work considering that 1 in 7 admitted to having sex while they're supposed to be working while they're at home. So that's an interesting stat. I can understand the reluctance to get back to an office.
I don't know how to comment.
This is what was reported. It's unbelievable. Yeah.
Okay, and the next slide. Just a look at ridership on the
we get a ridership.
And the New York City subway system. You can see that we're about 70% of where we were pre-pandemic here in New York. And San Francisco slightly below 50% of their 2019 levels. On the next slide, this month we saw the Fed pause its interest rate hikes after 14 months of raising rates and 10 consecutive hikes. They did, however, in their summary of economic projections, reflect that there's probably another, at least at this point, they're planning another 2 potential 25 basis point rate hikes at some point this year. And the market is pricing in a potential hike for the July meeting and perhaps in September as well. In Europe, we continue to see the ECB and the UK raising rates, and that is likely to continue given the stickiness of inflation there, and the fact that the rates, their official rates are still below those of the United States. On the next page, just a quick look on the far right-hand side, the top chart, you can see where we wound up in a range of 5 to 5.25%. Again, the Fed is on pause, perhaps just skipping one meeting, but it is a fairly aggressive rate hiking cycle when you look at it compared to the rate hikes over a 30-year period. And finally, on the bottom, financial conditions are actually higher, which reflects tighter monetary conditions in the market, which should also slow growth. Maybe skip the next slide or just touch on it briefly. You can see in red the dramatic increase in rates, again, over a 420-day period of 5 to 525 basis points in rates. On the next slide, Kate, 2-year yields have risen substantially this year. It's the U.S. Treasury rate outside of bills that is most sensitive to Fed policy changes, and rates are significantly higher in 2s. Credit spreads have also been wider, particularly given the economic challenges and the challenges we saw in the regional banking sector in March and April of this year, but they've been actually tightening in more recently. On the next slide, just a quick look at the yield curve inversion. On the far right-hand side, that's the spread between 2s and 10s. 2-year yields right now are about 95 basis points above 10-year yields, again, pricing in or reflecting the expectation the market has for a recession at some point in the future. And then the next slide, just a look at where those yields actually are. 2s in white are at 4.74%, pretty much where they were this morning, and 10-year yields at just 3.77%. On the next slide, I mentioned credit spreads had widened, but they've actually tightened in. On this slide, on the far right-hand side, in yellow, you can see high-yield credit spreads relative to comparable treasuries are about 408 basis points. That had been significantly higher earlier in the year, particularly given shortly following the regional bank issues, but they've tightened in the stretch for yield. And investment grade credit spreads are at 133 basis points, you can see on the lower right-hand side. Again, moving along just quickly, the U.S. dollar continues to be somewhat strong relative to other currencies, and that has to do with a few things. Certainly the robust economic growth that we've seen in the States, as well as the higher level of base rates and interest rates here in the United States. You can see in the next slide, just looking at the euro, the pound sterling versus, and the Japanese yen versus the dollar, and the dollar continues to be somewhat strong. U.S. stock and bond market returns. Investors in bonds continue to allocate money into that sector given the increase in base rates and the relatively attractive credit spreads. Relatively attractive, I say with air quotes around it, because it really depends on your expectation for a recession and defaults longer term. We are coming through the debt ceiling aftermath, meaning that we have gotten legislative relief that was resolved. However, the Treasury's general account had dwindled down to just about $40 billion, and the Treasury, with the help of the Fed, is actually in the process of issuing a lot of U.S. Treasury bills to restore that up to around $600 to $700 billion, which will actually drain bank reserves and may slow economic growth in the coming months as well. World equity markets, you can see on the next slide. On the far right-hand side, you can see two columns. The second one in shows the yield, the percent return year to date. It's actually quite positive for the U.S., Europe, and Asia Pacific in terms of almost all green on that screen. The far right-hand side, percent year to date in currency, that assumes that we are a U.S. dollar investor, and we're bringing those dollars back to, those currencies back to U.S. dollars. So the returns will be either higher or lower, depending upon the changes in the currency from the start of the year. But again, it's pretty good news for equity investors generally, as there's a lot of green on their screen. On the next slide, a quick look at sovereign bond market yield spreads. And you can see on the far right-hand side, most yields have actually moved lower year to date. A couple of notable exceptions in the UK under EMEA. spreads are actually 73 basis points, or I should say, sovereign yields are 73 basis points higher. But as a general matter, they tend to tighten here in the States as well by about 10 basis points. And which means tighter or lower sovereign yields means higher bond prices. On the next slide, a quick look at volatility. Equity volatility has been muted somewhat recently. On the left-hand side, you can see that the VIX, which has been actually under 15 today and it was under 14 last week, is a very low level relative to its historical average of about 19. And on the right-hand side, you can see the MOVE index. It looks at Treasury market volatility. It is still elevated, again, given uncertainty around Fed policy, concerns around the debt ceiling crisis, which has been averted, and the economic growth outlook in the States has created some level of volatility in bond prices. Market returns in the next slide. On the left-hand side, you can see there's a nice upturn in the Russell 3000, the MSCI EAFE, as well as the emerging market indices are all moving higher. On the far right-hand side, that is the Bloomberg aggregate return. You can see that last year was really an outlier in 2022, as Ed suggested and I've talked about in the past, one of the worst bond markets in perhaps over 100 years. But the Bloomberg Ag is now about 1.2% in the positive year to date. On the next slide, this is just an interesting look at equity returns here in the States. It actually gives the composition of the Russell 3000, which we talk a lot about. Russell 3000 is in white, and that tends to be a broad index that encompasses small and large cap. I think the really interesting thing about this slide, though, is the red line. That actually is the return for small caps. And as you can see, the returns have significantly underperformed large cap stocks in green, particularly on the far right-hand side. I will caveat that by saying that the large cap outperformance is really driven by only a handful of companies. And those 7 companies include Apple, Microsoft, Alphabet or Google, Amazon, NVIDIA with the AI buildup, Tesla, and Facebook or Meta. It was also interesting, I read over the weekend that Apple's current market cap actually exceeds the entirety of all 2,000 stocks in the Russell 2000. So Russell 1000 plus the Russell 2000 gives you the Russell 3000 returns. But again, all those returns are being averaged up and pulled up by just a handful of stocks, the 7 in particular that I mentioned earlier. In terms of recent news, on the next slide, I mentioned the regional bank, I wouldn't say crisis, I'd say challenges earlier this year. The challenges seem to be somewhat contained, but I do think there's probably more pain to come. So it's calm for now, but I think that at some point there'll be a refocusing on the banks. On that note, on the next slide, it actually takes a look at the percent of cumulative assets by bank. And you can see that the 2 main ones that we had that were challenged were First Republic Bank of California, which is taken over by JP Morgan, and Silicon Valley Bank. They're highlighted or they're pointed to in that chart. Anything to the right of that chart, those bank names at the bottom, are potential risks. And I do think the fact that you're going to see increased regulation and the cost of regulation for these banks is going to go up significantly, as well as the tendency for deposits to run when there are other attractive alternatives in the marketplace with higher yields. I think that perhaps leads to problems in the regional bank sectors down the road. I should also mention that bank consolidation is likely coming. 25 years ago, we had 13,000 banks in the United States. We now have 4,000 banks. That still is an outlier. Around anywhere in the world, we have a lot of banks. And it's not to say that's a good or bad thing, but I do think there's probably more consolidation for efficiencies coming. The next slide is also a very, very interesting slide. Look at the far right-hand side. On the lower portion, you can actually see the national average interest rates that checking accounts are paying and savings accounts are paying. And that's very close to zero. It probably equates to about 22 basis points relative to the Fed funds target, which you can use as a proxy for T-bill yield. So there's a significant increase in, or pickup, I should say, in putting your cash in T-bills relative to leaving it on deposit at a local bank. Those are averages. That doesn't apply to all banks, and there are other considerations in terms of locking up your money for, 1, 3, 6, 9, or 12 months. But it does underscore the fact that the banks have been somewhat stingy in terms of the deposits they're paying, and for those individuals that have an iPhone and can quickly move their money into something else, like a money market mutual fund, they're doing so, which is, I think, a challenge. On the next slide, just increased food for thought. This actually looks at the commercial and industrial loan spreads. On the far right-hand side, you can see in green, they're about 1,500 basis points over comparable benchmarks. And on the far right-hand side, the lower portion in blue, those are the high-yield spreads that I talked about earlier. And what that slide basically indicates is that credit spreads have widened, that credit conditions are tightening among banks, and at some point, we'll probably see high-yield spreads become cheaper, meaning wider and move up. So it may be a great place to think about investing over time. Moving on to a quick look at your portfolio's returns on slide 31, Kate Wilfredo. Just to look at public market returns. Here we're focusing on the first quarter of 2023, somewhat backward looking at it, as we're almost towards the end of the second quarter. But you can see that column is all green. So equities have returned nicely for the first quarter, as have fixed income securities. I think the other thing worth noting is if you look at the equity developed international, or ex-US, up almost 7.5%, outperforming the Russell 3000 stocks we talked a little bit about earlier. The other thing, takeaway here is the one-year chart continues to be all red, and that's reflective of the significant sell-off we had across all assets in tandem in the second part of 2022. Still some work to do to make up those losses. On the next slide, I'll look at the police's net public market returns by strategy. Again, the good news here is in 3 months for the first quarter, it's all green. But still challenged for the year in terms of we're coming in at negative yields and returns for all the asset sectors with the exception of cash. On the next slide, I'll look at net private market returns. Here, looking at 3 months, you can see we had a negative return year to date. In the 1 year period, I should say, for hedge funds, it's down 2.4%. Private equity with the mark-to-markets, again, these mark-to-markets are through December 31st of last year, coming in at 3.5% down, and positive returns in the other sectors. More importantly, on the bottom of the page, you can see the police total plan returns in aggregate, and that includes private and public markets. For the first quarter of the year was up 4%, relative to down 4% for the full year. More importantly, however, you want to look at it, say 5 years, and the plan has returned on average, notwithstanding the challenges of 2022, 6.8% net returns. On the next slide, just a quick look at the asset allocation of those returns. The total plan relative to its policy index has underperformed somewhat. That has more to do with the fact that there's about a 2.2% overweight right now in private equity. Relative to other things, relative to the target, and private equity has gone through the process of marking to market positions lower, which has been a little bit of a drag on performance. On the next slide, I'll look at police's public market excess returns in basis points, including private assets, and you can see all the way down, we've underperformed the Russell 3000, outperformed MSCI World ex-US, all the way down. Converse has had a little bit of challenges as well in the first quarter, but for the total plan relative to its policy benchmark, again, notwithstanding the fact that there's an overweight right now in equities, private equities, which have been off, are down just 95 basis points. On the next slide, a quick look at private market excess returns in basis points. Hedge funds have underperformed its index by 150 basis points over the course of 1 year. Private equity relative to the Russell 3000 has delivered 1,471 basis points of positive returns. And you can see all the way down, a little bit of exception for private real estate non-core, which tends to be a higher risk, and is traded off over the past 12 months as well. And the last slide here, just a look at summary rebalancing activities for the quarter. We obviously raised cash to be able to meet benefit payments and meet capital calls for private assets. And John Mercerberg was also selling some equities to rebalance into the international fund-of-fund structures that we have in place as well. And with that, I'll open up to any questions. I'm sorry it's so quick. I know we threw a lot at you.
All right, so if there are no questions,
Before we go on, I'd like to take a moment of personal privilege.
Can I do that first?
Sure.
A few things we want to do before you,
Oh, okay.
I know that,
Oh, boy.
but I'm the most important, so I gotta go first.
The most important person is over there, the office guy. She's got the record.
So as, Sens is bringing this up, I'm missing Nicole unfortunately here. But, I just want to start off that I've known Joe for about 20 years. I think I've known him longer than any of the trustees. The only other person is Stephanie that I know probably just as long. And, when I think about Joe, there's so many thoughts I have, diligence, hardworking, just incredible knowledge, a very well-read person. He knows more than me, he's told me that, which is probably pretty easy.
No, that's not true.
But the thing that really stands out to me is you've heard this before, I think we throw this around way too often, but putting your heart and soul into something. And I don't think anyone has any doubt in here that he has put his heart and soul into looking out for his members. It's just been incredible. And lastly, what I would like to say is, I consider him a friend, and I'll always be in touch with him, and I'm certainly gonna miss him at this table. But I'm not gonna miss you as a friend, because we are gonna keep in touch, and we'll go out and get a bite to eat, and
Maybe drunk this time.
Joe drunk? Never, by the way. And with that, we've got a plaque. On behalf of everyone here at the Police Pension Fund, Joe.
Oh, thank you. So, if you remind me, the privilege of reading it. Presented to Police Officer Joseph Alejandro, recognition of your well-deserved retirement from the New York City Police Department. We thank you for your decades of selfless service to the men and women of the department, the PVA, and your service on the New York City Police Pension Fund Board of Trustees. Wish you happiness and a long collection of retirement benefits from all your friends and colleagues at the Police Pension Fund, June 30, 2023. Thank you very much. Yeah. I didn't Sure. You can take a look at whatever you want.
We also have a retirement fund with a lot of money in here.
Is there $1 billion in here?
All right.
Thank you very much.
Kevin, you can last.
Oh, of course.
So, not to be outdone by the fund,
Oh, boy.
the controls
Is
office.
this the, we're happy you're gone, one, or whatever?
There is a lot of that, Joe, but, you know, incidental to the VSF that you'll be receiving
Oh,
every
yes.
December 15th, we have a couple of things for you. First, before we give you that, your nameplate.
Oh,
from the
excellent.
Common Investor meeting, which I know you long for those days. And then,
I could say I was actually somebody at one point, yeah.
and then, Joe, this is all wrapped up, so you can, your very own.
Oh, my God.
Proclamation.
And we're gonna give you this proclamation from the controller, and then I'm gonna post the video of you saying nice things about him on Twitter.
And I'll be very careful how I say it.
See, I'm telling you, that's why you're retiring. It has nothing to do with it.
All right. To Joseph Alejandro, Second Vice President, Police Benevolent Association, for his extraordinary dedication to the city of New York including nearly 40 years of service to the New York City Police Department, initially as a police officer and since 1999 as a representative to the Police Benevolent Association, the nation's largest police union, for his exceptional commitment to protecting the rights and improving the lives of members of the PBA, for serving 24 years as a trustee to the Police Pension Fund, protecting the financial security of almost 85,000 participants, for attaining the admiration of fellow trustees and pension professionals, which includes his willingness to explain to his colleagues again and again how things actually work. His tact, diplomacy, and pleasant demeanor, for generously supplying the Police Pension Fund with a vast reservoir of institutional knowledge, and for gaining the respect, appreciation, and gratitude for all he worked with, and for his tremendous contributions to the city of New York, signed by Brad Lander. Joe, this is for you, and I just want to say on a personal note, you've been a great friend for 20 years, and I just want to say, when I started, Joe was the fourth loudest guy in the room, and slowly, over time, became the loudest guy in the room. But through all that, Joe may ask questions that make us uncomfortable, but they're never unreasonable. And he does that because he cares about the fund and he cares about the members. And I think in some way, he cares about all of us too. He just doesn't want to admit it all the time.
No.
But,
Thank you.
Yeah.
Thank you. Wow, I didn't expect Brad to say something nice about me, but I will say something nice in return about everybody here. I came in with no knowledge of what this fund does, just basic knowledge 24 years ago. And I knew I had to learn a lot very quickly. There were some great individuals here, predecessors of some of the members here. Tony Garvey, God rest his soul, taught me a lot. Everybody here taught me something. I always said that if I leave this table not learning from somebody here, I've wasted a meeting, and I really mean that. I have served, oh my God, several mayors, 7 controllers, 7 police commissioners while I'm here on this board. I would say CIOs, from the very first CIO, Andy McIntyre, I would say it's been an interesting ride here. Sometimes I've battled here. I think I've come from a good place in order to have those battles. And I would say I don't fault people at BAM. I fault no one here. We just come from a different place, and we hope to get to the right decision. We may disagree, but I try sometimes not to be disagreeable. That doesn't come through. But I've been here at this table with many controllers. Brad and I first met over a year and a half ago. It was an interesting conversation, needless to say. I would say that I think in that year and a half, we've got mutual respect. We may not always agree, and as I said, there are times we could hold hands, and then there are times we put on the boxing gloves. That's the way it is. But I think it's for the right thing, for the members, for this fund, and I've always tried to approach it that way. So I would say I'll measure the success of being brief, and the fact that I'm actually getting plaques because there have been trustees who have left with nothing. So I don't know whether to take this as we're happy you're gone or we're really happy you're gone, but I'll take it as you're happy for me, and I appreciate that. I want to thank you all for the work you did and do. I think it's important. Police officers are counting on you to provide their funds going into the future, and I think that's the main thing, that we keep track of those people who are now in radio cars or on foot posts, dealing with danger, running in when everybody's running away, and they're relying on you to protect not only their future, but in some cases, unfortunately, their families. And And now I guess we could go into executive.
All right, I'll second that.
No.
Cole, do you have the plaque?
No, I'm kidding. So if, Dan could stop the recording, please?
I want Johnny to have the privilege of
Okay.
seconded my final motion.
That's fine. So, all right. So next, okay. Camera is on. Kevin?
Ready to go?
Yeah.
Sure, okay. During the executive session, the trustees heard from their consultants, BAM, and several managers regarding the following: private equity, alternative credit, real estate, and hedge funds. Decisions were made. Those decisions will be made public at the appropriate time.
So with that, Joe, on behalf of the Bureau of Asset Management, you've been a great colleague throughout the years, and as a trustee, you've been a great colleague. So thank you for all that you've done for this fund over the last 24 years. And your fingerprints will be on this fund for many, many years to come. Thank you for all that you've done. And with that, I believe that there should be a motion to adjourn, and
I make a motion to adjourn.
and is there a second?
I second that motion.
All right.
Thank you, John.
Great.
Thank you, everyone.
Stand adjourned. Thank you.